Welcome to Magellan Minutes. I'm Nadine Blaney. Well, housing affordability writes the headlines here in Australia, but surging construction costs are a less recognized driver of that inaffordability. And those construction costs are reshaping the housing supply and the construction sector in general. To explore what this means for investors in REITs and to give us an update on the property sector in general here in Australia, I'm really pleased to be joined by Jack McNally. He is Senior Equities Analyst at Airlie Funds Management. Jack, great to have you here today.
Great to be here.
So Jack, can you walk us through what's happening in the real estate sector, sort of from a top-down approach and some of the key themes that are really driving the sector?
Yeah, for sure. So it's been a difficult couple of years in the property sector, and that's just because we had interest rates at 0% during the pandemic, and they've risen to above 4% due to higher inflation. Now, over the last year, we've begun to see some green shoots in the sector. Interest rates have peaked and are now falling, and then the asset values within the sector are also beginning to rise again. And for the REIT sector on the ASX for F25 returned about 14% for the year. And so maybe it's good to do a bit of a round the ground in terms of the different sectors. So we'll start with office. Again, a much maligned sector due to the work from home trends and the effect that that's had on office demand. But we actually began to see some green shoots towards the back half of the year. And we're not saying that we're bullish on the office sector just yet, but it was interesting to see some of these trends. And so the first one was that absorption, which is the difference between the amount of space leased versus the amount of space vacated, was actually positive across all four major Australian CBDs, with Sydney recording its highest in over 9 years. The other one was incentives, which is the amount that you pay towards a tenant in order to entice them into a lease, and is generally predictive of how hot or cold the market is. They're still at a very high level, but we saw that they began to fall as well in the final quarter of the year. And even companies like Dexus began to show positive rental growth of 2% over the year. Turning the other page to industrial. Now, that's been a great sector over the last few years. E-commerce continues to be really strong, and that was, in fact, boosted during the pandemic, where everyone was stuck at home and buying a lot of goods. And as a result, rents within the sector have really surged over the last few years. The interesting thing, though, is that that's actually started to show signs of cooling off. And that was from a very high level, in fact, where the vacancies were really low, incentives were really low, and there's been a lot of rental growth. But we've actually seen some of those trends begin to soften in the back quarter of the year as well. And then finally, retail. Despite all the doom and gloom, retail REITs have actually performed reasonably strongly. There's a bit more strength within non-discretionary. Mm-hmm. However, discretionary is still tending to hold up, but it's consistent with the broader trends that we've seen in the macro economy in Australia. And we've even seen GPT, which is a key retail landlord, its rents grew by 6% during the year, and vacancy remains incredibly low across that sector.
And that includes Centre Group and Region as well?
Yeah, that's correct.
All right, so that's a really great overview of how the property sector is performing overall. But if we zoom out a little bit and we think about the context of housing affordability, but looking at it through more of a commercial property lens, it's an interesting idea, but I suppose as an investor, what do you do with that?
Well, why don't we just discuss the housing affordability component first? And so housing affordability, as you mentioned at the start, it's in every news line of every day, and we see a lot of culprits that are discussed, such as negative gearing, high immigration, or even interest rates. But I think what's a thing that's probably overlooked or not given enough credit or importance is construction costs. So put simply, if it's too expensive to build a new house at a given price, it's not going to happen. And if for as long as that takes place, supply will remain constrained, and as a result, there'll be continued pressure on prices. And so what's happened over the last 5 years is we've seen construction costs go from increase from roughly 30 to 40%, and that's a function of a few factors. One is raw materials prices have increased post-COVID, and then the other is simply labour availability. So there's been a lack of skilled migration into the sector. And then on top of that, within the available workforce, all the infrastructure work that the state governments have been doing, such as the Metro in Sydney or other projects like hospitals around the country, it's really sucked away the available workforce, and there's simply just not enough there for construction, for housing construction.
So when you look longer term, I guess productivity, it's an obsession of the RBA for good reason, correct?
Yeah. I mean, it's everywhere in the economy. There's been struggling productivity over the last 10 years. But we generally expect it to be productivity within the sector to be stable, if not increasing over time. And construction is actually one of those interesting sectors where productivity has declined. In fact, we're only building half as many houses per worker over the last 50 years. And there's a whole range of reasons for that. But the conclusion is that it's not great for supply.
Okay. So when you combine as well population growth, you talked about migration, but also population growth, that post-COVID population peak, how do we see that playing out then?
Yeah, well, all the factors have just been overwhelming, really. The population growth, obviously people need a house to live in. But when we layer that on top of some of the supply constraints with building activity at subdued levels, despite prices remaining reasonably high, where you'd think you'd see a lot more construction, what we've seen is, despite rising interest rates, housing prices have actually continued to rise over the last few years. National vacancies within rental markets are very tight at like 1% vacancy. And the result is surging rents within the residential market as well, as we've seen.
Okay, so what are the implications then when it comes to commercial property?
Yeah, so it's much the same. Whether you're building a house or whether you're building an office tower or a shopping centre, the fact is that it's costing 30 to 40% more in terms of construction over the last 5 years. And so put simplistically, if for a new development to make sense, we'll need rents to have grown by the same amount over that period for people to be incentivised to build that new supply. And if we look at the facts, it simply really hasn't been that case across a lot of sectors. So Dexus is a good example. Rents have only risen by 13% over that period in time. Scentre Group, which owns Westfield shopping centres, they've been performing strongly recently, as we said, but they've only grown by 18%. So there's not enough rental growth to justify a new development. And perhaps it's best to use an example to discuss the impact of these higher construction costs that have taken place over the last 3 years. And we'll pick on Dexus a little bit. If you're a Sydney sider, you may have noticed they're building a big office building for Atlassian on top of Central Station. Now that began in 2022 and it's expected to complete over the coming years. And the expected return that they're hoping to generate within that development is about 4 to 4.5%. And when you take a step back and you think that, well, you can purchase a new office asset for a greater than 6% return without the development risk, it really begs the question of why going forward people would want to be doing more office development. And so we think that taking a step back, that bodes very well for if you're an owner of existing established real estate. It bodes very well in terms of increasing rents and in terms of low vacancies, which is ultimately supportive of valuations.
So given those dynamics, which are fascinating and, makes complete sense, where are you finding then attractive opportunities?
Well, I think more broadly as the thematic, it's that owning established real estate will be profitable due to those things that have been discussed until rents rise sufficiently. But within the portfolio, Charter Hall's an example. Now, that's one that we last spoke publicly about a year and a half ago, and the market was really concerned about the short-term direction of interest rates, coupled with the outlook for the office sector. Fast forward, they've had a strong year and a half. Interest rates, as I mentioned, are beginning to fall. Valuations stabilising and beginning to grow again. That therefore allows a bit more transaction activity, the ability to grow its AUM and then collect performance fees like any fund manager does. And so assets under management for the business is around $70 billion of property assets. And we expect that they can grow that to over $100 billion over the medium term and grow earnings per share at low double digits. And then finally, Region Group is another one. So they've had a difficult couple of years. They are the owner of neighbourhood shopping centres. So think about your local with a Coles or a Woolies, perhaps a butcher, a gift store and a couple of pharmacies. Earnings for them have fallen over the last few years by about 11% due to higher interest costs. Inflation, where they cover some of their tenants' expenses, as well as some vacancy due to the administration of a large retailer. But as we look forward, all those factors are beginning to reverse. We think they can grow earnings at their target of 3 to 4%. And with a 6% dividend yield and pretty defensive earnings anchored by Coles, Woolies and safe tenants, we think it's a pretty attractive risk return.
Thanks, Jack, so much for your insights today. Really appreciate it.
Thank you.
And thank you for joining us. And please feel free to share this with your clients and colleagues.